Welcome to PID. This is time for our webinar. As you all know, we do a lot of webinars deliberately to try and start a national conversation on economics. And we invite a lot of people, both from Pakistan and outside Pakistan, the key thinkers in the world. So today we've got a very important webinar talking about economic management in a multiple equilibria economy. We are joined with Mr. Smithers. He is Andrew Smithers, who's the CEO of Smithers and Company and an author of many books. So Mr. Smithers is going to tell us about the new form of economic management, the multiple equilibria economy. I'm very excited to hear about it. Mr. Smithers, PIDE is a very old think tank in Pakistan, and we are trying to, this country, though it needs economic help, but it doesn't pay attention to economics. We're a politically charged country. We don't like economics. So we are trying to excite a debate on economics. So thank you for joining us, and we'd love to hear what you have to say. So over to you, Mr. Smithers. Please take it away.
Thank you very much. Well, first of all, I'm very honored to be asked to talk to you today. And I would like to thank the Vice Chancellor for his invitation and indeed for his flattering introduction. And also to thank Professor Haque for having organized this discussion. Now, I hope, by providing ample thought for the discussion, I can repay the Institute's kindness in making this invitation, and also the kindness of all those of you who are listening in to taking the trouble to do so. So thank you very much. And if I may, I would like, therefore, to move to the first slide. Now, I'm going to start by outlining the key failures of the major developed economies that we've had and experienced this century. Now, there are three possible causes for this failure. They are, I think, 1, bad luck, 2, bad management, and 3, that policy has been based on bad theory. I conclude the fault lies with the policy being based on bad theory, not the incompetence of central bankers. It is not to them that we must contribute this failure, and I therefore suggest that policy must improve, and so theory must therefore improve. I will show also how in each case that can be done. Slide 2, please. Slide 2, please. Okay, just examples of failure. Firstly, output this century has barely grown. Secondly, we've had the deepest recession since World War II. And thirdly, this was due, like 1929, as so often before, to an asset bubble followed by a financial crisis. Unfortunately, these conditions are exactly what we have again today. So we don't necessarily have to have another financial crisis, but the conditions for it are ripe. I'm going to illustrate now this, if I may, with the next slides. Slide 3, for example, this slide, the date on this slide ends in 2019, so we cannot attribute the problems of either the invasion of Ukraine or COVID to the problems. What they show is that the growth of these economies this century has been less than half than it was for the previous 50 years. COVID cannot, therefore, be one of the causes of the slowdown. If we now look at slide 4, we can see that the impact of financial crises has become increasingly severe. The recession which followed that of 2008, which is shown up on this screen, was the deepest and most sustained since the slump of the 1930s. You can see in this chart that in the 50 years from 1950 to 2000, neither France nor Japan had a single recession, and they didn't that they had big ones in the next period, and that the recessions that the Germany, the UK, and US suffered in the second period are much, much greater than they were in the first period. Look then now in slide 5. I can show you 2 or 3 things which I hope you will find of great interest. The first point is that we can measure the level of stock markets. Stock markets are mean reverting. We can tell when they are high and when they are low. When they are high, they give bad returns. When they are low, they give good returns. And we can measure this because on the long term, they give the same return. Returns on stock markets are mean reverting. Now, Stephen and I showed that you could measure these markets in a book which we call Valuing Wall Street, which we published in March 2000. And Bob Schiller did the same thing at the same time, oddly enough, showing that you could do the same thing by a different measure, which is the cyclically adjusted PE or Haque. Now, if these were valid measures, they would give you the same result. They are valid measures, and they do give you the same result. And what they show is that we've had bubbles in 1929, 1937, 1999, and 2007. And each of those was followed by very large increases in unemployment. We have, I'm afraid to say, another bubble today, and therefore we are facing a big risk of another rise, a substantial amount, in the unemployment levels in the United States, with, of course, the knock-on effects that one can expect for that, or from that, for the rest of the world. We have another problem, which is inflation, which I can illustrate in slide 6. Now, slide 6 shows that inflation bumbled along within a reasonably close barrier between, say, -1 and just over 3 from 1963, basically until 2019. And M2 was also pretty much under control. That is the broad measure of money supply available in the United States. However, when inflation started to go up, it was preceded by a very sharp increase in money supply, which broke through its previous levels in about 2013. And we then had, 5 years later, the sudden rise in inflation, which has then gone up together with money supply. We now have money supply at levels relative to GDP, which we've not seen since the oil crisis, and it has followed, as that did, by an exceptional increase in the domestic supply of money. Now, if we turn, however, to the timing of this, which I show in slide 7, you can see that inflation in the red line was going up rapidly. Back to page 7, please. Slide 7, if I may, please. You can see that inflation took off well before Russia invaded the Ukraine. So we cannot again blame either Putin's invasion of Russia or inflation. We can't be blamed for that. We can blame it, however, for the increase in money supply which took place before. If we then turn to slide 8, we can see that the other things which I'm referring to, growth slowed before COVID, as did the financial crisis and the recession, and inflation came before the Ukraine war. So we can say reasonably that slow growth, inflation, and the current asset bubble predate the COVID war and the arrival of COVID and the war in Ukraine. They have added to our problems, but they cannot be blamed for them. Unless stagnation, financial crises, and inflation are inevitable, economic policy in the 21st century has been, frankly, an abject failure. Okay, let us then turn to who's to blame, which I illustrate in slide 7, or ask questions in slide 7. Slide 9, I think upon slide 9. Right, as I mentioned earlier, we have 3 alternatives, and the first one is that it's bad luck. And I've dismissed that because the problems clearly arose before the major problems which we can reasonably blame on luck were with us. Now, rational policy must be based on theory, and furthermore, it can't be better than theory. At any time, this theory must be the one that's generally agreed. Today, this is the consensus model, which I shall refer to in future as CM, consensus model. Now, I think it is that which is to blame. And I draw an analogy here between the 21st century's economic failures and the 18th century's medical ones. Now, in the 18th century, doctors reputedly killed more patients than disease did. They were not incompetent, those doctors. They were competent executors of bad theory on which to base their diagnoses and prognoses and cures. If the CM is valid, we must blame the failure of 21st century policy on the incompetence of its policymakers, with central bankers obviously being the prime suspect. But if CM is invalid, we can blame not the executors, but blame economics as a profession, as the cause of our problems. Slide 10, please. Now, we come now to a key issue, which is whether or not we live in a world in which there is one equilibrium, which is needed to keep the economy balanced, or whether we have several. Now, I follow famous economists, notably George Akerlof and Ricardo Caballero, in holding that the single equilibrium follows naturally from the consensus view. And what the consensus view is, it holds that if you keep demand in balance, that's all you need. You can put this in neo-Keynesian terms. You can say that provided the ex-ante net savings is at zero, i.e. intentions to save and intentions to invest are balanced, you will then get a balanced economy, and that is all you need for a balanced economy. The prominent economists that I mentioned are skeptical of this, and indeed, I think we can reasonably say that quite a lot of other people are as well. So we can turn then to slide number 11, which explains why the consensus model has this single equilibrium conclusion. It has a number of assumptions which lead inevitably and inexorably to that conclusion. One, it holds that real returns on long-dated bonds and equities vary with short-term real interest rates. Secondly, these constitute, by the way, in whatever the usage, you can put them together in different amounts. But the cost of capital is a function of those three in various proportions. If they all go together, the use of cost of capital must therefore vary with short-term interest rates. And it is assumed, in addition, by the consensus model, that companies vary their investments with the use of cost of capital. Now, if the economy has more than one disequilibrium, then we will not find that by keeping the demand at its stable level, i.e. at the zero net ex-ante savings surplus, we will be inevitably in trouble because the policy will not be adequate to keeping the economy stable. models must be tested is the important message here, which I put in the heading. Any model will fall if its assumptions are wrong, and the consensus model will therefore follow if its assumptions are wrong. The assumptions of valid models must be testable. If they're not testable, they fall the wrong side of Karl Popper's famous demarcation between science and non-science. And if they can be tested, then we know that they must be robust when tested. They must not be falsified. So these are the two conditions of valid models. They must be testable and they must be robust when tested. When the model was put together in the 50s, there wasn't really any way you could test it. Some economists who were then teaching at Cambridge when I was up at Cambridge, notably Nicky Calder and Robin Maris, they objected to these assumptions being assumed because, as they said, we cannot take assumptions as being correct unless they are testable. But from the 1950s to the 1980s, testing has been extremely difficult. So we've had a consensus model which, without necessarily any fault of its own, has fallen the wrong side of Popper's demarcation. It was an invalid model because it was untestable. However, in the 1980s, or perhaps a little before in some instances, data on financial markets has made the consensus model testable. Unfortunately, it has remained pretty unfashionable to test it. And that is perhaps because, when tested, it is shown to be wrong. The CM has changed its nature, really. It used to be unscientific because it was untestable. It's now unscientific because its assumptions are falsified by the data. It's not necessarily a wonderful progression, but it is the one that the consensus model has followed. Okay, in 13, I'm going to give some examples of this. Slide 13, please. Now, I can quote I think the references to these will be as follows. Ray Fair published a thing called Reflections on Macroeconomic Modeling in 2015 in the Journal of Macroeconomics. James Mitchell published his work in the third appendix to my book, Wall Street Revalued, which was published in 1909 by Wiley. And I have published a number of reasons why this consensus model fails in my recent book, which is called The Economics of the Stock Market. That's published last year by Oxford University Press. If we go through these in turn, we can see, firstly, that Ray Fair showed that the assumption that investment was linked to the real exchange rate fell down because he showed that if it was linked to exchange rates, the link was actually much more with nominal than with real rates. And James Mitchell showed that while equity returns did move in the very short run with real interest rates, it was only a very short run effect that didn't have any connection over time. And I can illustrate that in the next chart, 14. In chart 14, I show the returns. Now, you can see from this a number of interesting features. Firstly, you see the mean reversion of equity real returns. The green thing wanders around a stable average. But neither of the other do too. And these are quite long periods. All these are measured over 30 years. We've got data now from 1801 to 2022, but I only did this a little while ago, so excuse me, it's only up to 2018. It doesn't change, of course, add in the next 4 years. What it shows is that the equities are mean reverting, but the other two short-term deposits, cash, short-term interest rates, and bonds are not mean-reverting, even when measured over 30-year periods. And secondly, that the three are not related. There is no relationship actually between bonds, cash, and equities. There is a short-run relationship between the three of them, and that short-run relationship lasts longer between bonds and cash than it does between bonds and equities or cash and equities. But even then, over time, there is no long-run relationship with any of them. We can then turn to the obvious conclusion that follows from this in chart 15. And chart 15 shows clearly that, as when tested, the assumptions are wrong, it's going to lead to the wrong conclusion. And we know from experience, I think, you'll agree, that we do not live in a single equilibrium economy. We've had recently, for example, the experience of inflation suddenly picking up without any evidence that the economy in America or else other major economies was out of sync in terms of its demand. And we've got the concern of an asset bubble equally, without any sign that this has been signified by anything like demand. So we therefore are living in a model of an economy in which the conclusions of the consensus model simply do not follow. If then we turn to slide 16, we can look at asset prices. And I put and debt, and I will say that it has not been possible, as I know, to produce any strong relationship between debt and anything else. But you accept debt does seem to follow with asset prices. When you get high asset prices, you also get, not surprisingly, people being prepared to lend more than they otherwise would. So I've called this asset prices and debt. Now, I showed in chart in slide 5, perhaps we could quickly go back to slide 5. Is that possible? If not, well done. Slide 5, that we can identify asset bubbles. This is how we can do it. Okay. Now, secondly, that those have caused financial crises and have been followed by large increases in unemployment. As we can measure asset prices, and we know when they become dangerous, it's clear, I think, that we should, in due course, aim to avoid asset bubbles. Thank you. If we then turn from asset problems, which I outlined in slide 16, to money supply problems, we have another problem of stability. Slide 17, please. In addition to the instability that you can get from asset bubbles, there is also apparently an instability from money supply. Now, to say that monetarism is a contentious issue is probably as good an understatement as you can get from an economist. But I think that without having a satisfactory model for how money actually impacts on the economy, and certainly it is very difficult to show how short-term changes or indeed small changes in money supply have any impact on the economy that we can devise. If you look, however, at large moves, you will see that as a pragmatic point, very large increases in money supply do seem to be followed by rapid rises in inflation. And since we don't want rapid rises in inflation, it is sensible that not only should we seek to avoid asset bubbles, but we should also seek to avoid too much growth in the relationship between money and GDP. Okay, if we go then to slide 18, we can see that I have identified, therefore, three separate causes of potential imbalance in an economy. Now that means there are three things we must try and control. Now, if you want to control something, you have to have a policy instrument to control it. And what is more, that policy instrument, as you're trying to control three separate things, must be independent. It must be able to pinpoint that particular problem without creating problems elsewhere. Now, this rules out quantitative easing. Quantitative easing may supplement interest rate movements at the short end. Basically, it's a method of trying to control long rates as well as short rates. It may be able to therefore boost demand in conditions when short-term interest rates seem to have failing, where we're falling into a liquidity trap. But we can't use it because it causes asset bubbles. The relationship between QE and asset in the short time we've had both available is far too strong to be anything but a real scare story. QE is not an instrument that we can use. So what we've got really is three causes of disequilibrium. We've got demand could be out of sync, asset prices could be elevated, or the relationship between money and GDP could be elevated. If we're going to control those three separately, we need three separate policy instruments, and those that are currently being thought of and used in government and central banks are only two. We've only got short-term monetary policy, short-term changes in interest rates, and fiscal policy, short-term or even longer-term changes in the degree of the budget deficit. And we need another instrument if we are going to control an economy which has three possible causes of disequilibrium. Okay, we can look therefore at the next slide. What is equilibrium demand? Well, that is one of the conditions of stability, and you can recognize it because unemployment and inflation are both low and stable. Now, in common terms, and I think this is a useful expression, even if you can't actually pin it down, demand must be at the non-accelerating level of unemployment. That concept gets reasonably attacked because you can't pinpoint what it is at any one time. But while that is a reasonable criticism, it doesn't stop it being a useful description of the conditions that we wish to acquire or obtain. That is the CM's single equilibrium. That is the time in which ex-ante net savings are zero, when the intended savings and the intended investment of the economy, with the help not only of the private and foreign sector, but also of the government, are in equilibrium. If we then turn to the next problem, which is the liquidity trap problem, slide 20, we can see that if that condition applies, you would be okay in terms of demand. However, as Keynes pointed out, there are levels when monetary policy ceases to work, when interest rates get very low, partly because you get famously to the point at which you cannot reduce nominal interest rates below zero. Then, as Keynes pointed out, you need something to supplement monetary policy if you're going to avoid unemployment rising simply because there is inadequate demand. And he pointed out, and his views, I think, are now generally accepted, that we need to use fiscal policy then, i.e. we need to vary the degree of government spending relative to government revenue. budget deficits need to be increased if we have a liquidity trap. Now, if we then turn to the problem, which we've got in this century, in slide 21, we see that liquidity traps were assumed by Keynes to be cyclical, short-lived things. Now, we know, however, from our experience this century, and perhaps particularly in Japan over perhaps longer period, that this simply is not, unfortunately, true. And if you've got a structural or semi-permanent, and perhaps even permanent liquidity trap, and you cannot use interest rates to solve it, and you have to use, therefore, budget deficits, you get into the situation where you have an ever-rising debt to GDP. Well, at what level that will become a problem is uncertain. Japan managed to get a huge increase in its debt to GDP ratio without so far having run into any particular problem by it. But it is quite clear in theory, and I think in common sense, if theory can ever be different from common sense, that you cannot rely on an ever-rising debt to GDP ratio to keep an economy stable. You will get other huge problems arising, and one of which, of course, is that if the debt rises so much, and you then have a rise in inflation, you have it very difficult to control inflation because, of course, the debt ratio will rise because interest rates will go up. And an increase in interest rates when you've got a very high debt to GDP ratio just tends to escalate forever. So Japan, in that sense, has been lucky. Its large debt to GDP ratio has been during a period when interest rates have been low, but we cannot always rely on that. So basically, we do need an alternative to monetary and fiscal policy. When we've got structural liquidity traps, we need it always in terms of money, interest rates, because we know that liquidity traps cannot be dealt with by monetary policy. And when they are structural rather than cyclical, it is also unsatisfactory to try and deal with them by fiscal policy. We therefore need another policy instrument. As I set out in chart 22, I suggest that we use tax policy as the third instrument. Now, tax policy is not the same as fiscal policy. Fiscal policy means changing the budget deficit levels. Tax policy is switching the nature of the tax that you make. In this case, as I will explain, and we'll come on to that more fully later, I suggest that we change the taxation on investment and the taxation on consumption. And I will show in the next few slides how that will boost demand without having any change in the fiscal deficit being necessary. Thank you. Chart 23. Now, this is probably the single most important chart that I'm going to show you today. It has an abundance of information contained in it. And the conclusions that one logically comes from when looking at this chart are ones that I found cause real worries and are difficult sometimes for economists to even accept. The logic is clear, but the conclusions are so startling that they have trouble with them. The first thing is that the blue line is the annual returns, real returns from the US stock market. Every year for 220 years, we have these figures. Now, I'm showing these here, unlike the previous ones that I showed you, 30 years, for example. I'm showing them here as log percentages. The purpose of that is because the eye with log percentages will show the line going across very nicely around the median return. And the median return on these actually comes in at about 6.7, and it looks therefore that we have a stability in the equity return. It is mean reverting around a real return of 6.7, and that there, it doesn't matter which period you're taking. You can take the 19th century or the 20th century or half the 20th century. So there you have a stable mean reverting level from equity returns. And then in the blue line, I track against that the effective rate of corporation tax. Now, corporation tax is a complicated animal. It not only includes the rate that you publish on corporation tax, I think in history from 80 to about 55, I think in the US, from 0 to 55, sorry. But in addition to that, there are subsidies on investment. In America, there's been very strong subsidies since 1981 for R&D, and there have been others in other countries. In the UK, recently there has been some, both the R&D subsidies and some tangible investment subsidies. And basically, if you give a subsidy, it's equivalent of paying less tax. Another thing that happens here, though, is that you can surreptitiously vary the effective rate of tax if the tax allowances for investment change, or if they don't change and inflation changes, because inflation has an impact. If inflation goes up and you haven't changed the allowances, the effective tax rate has gone up because you actually need, with a higher rate of inflation, more depreciation to offset the actual cost of capital consumption. So having explained that, I will now try and point out some of the interesting conclusions. What you will see from this is that corporation tax basically didn't exist until 1916. In fact, there was a ruling in America that corporation tax, when it was first tried, was actually contrary to the Constitution. So they had to change the Constitution before they could introduce corporation tax. Having done so, it rocketed up in 2 world wars and has then come down again, both because the rate has gone down, but also because the allowances have gone up. Now, in spite of all those changes, there's been absolutely no change in the real return on equity. The inevitable and correct conclusion from that is that you do not change the return on equity by changing the rate of corporation tax. You do not change, I will repeat that, you do not change the return on assets directly which are paid for by equity by changing the tax. Therefore, the tax cannot fall on assets or profits. Now that I've been reading recently, some people trying to work out using the consensus model what will be the effect of changes in corporation tax. And the best paper I can find was an unpublished one by Willem Bouter and Sibbert. And they point out that this is a subject which seems to be often rancorous in debate. Basically, I think it's because you cannot actually produce a sensible answer from the use of the standard model. What this shows you, therefore, is that corporation tax is not a tax on investment. And in all the papers that I've read, it is assumed under conventional consensus theory that it must be. But clearly it isn't. Now, one conclusion that comes from that, which is one I found economists really finding absolutely startling, it means by definition that the return on equity before tax and the return on equity after tax are the same. That is a strikes most people as a startling statement. They are the same. What happens in practice is interesting. It is that corporations, of course, pay the tax, but they pay it out of cash flow, not out of profits, which means that the depreciation charge falls by exactly the same amount as the corporation tax, effective rate of corporation tax revenue rises. And that, if you think about it, is exactly what you would expect of them. It's not what economists seem to easily grasp, but it's what you'd expect. Because depreciation varies with the speed of growth of the economy. This has been well set out in a famous paper by Robert Solow, James Tobin, and others. And what it is, of course, is that once invested, the output of a particular piece of plant per person employed on it doesn't change. And so as wages go up, the value of that plant goes down. And that is the depreciation. And that depreciation goes up faster when wages rise rapidly than when they rise slowly. Now, another thing which the consensus model, in my view, is correct to assume, because it fits with the data, is that we live in a world in which the labor and profit shares of output are themselves stationary. They are mean reverting. This is the famous Cobb-Douglas production function. So what we're looking at is a world in which increases in corporation tax reduce corporate cash flow, they reduce corporate depreciation by the same amount, and therefore the result is that the return on equity is unchanged. But what it does do, of course, is it reduces the expected return on new investment. So if you've got an unchanged cost of capital and the return that you expect goes down because it will be paying corporation tax, then you invest less. And that is exactly what happened. We are looking here at a fascinating chart, to my mind, one which, sadly, consensus economists don't look at. They have, by and large, completely ignored the stationarity, the mean reversion of real returns on equities. And they have not, I think, in any paper I can find, used that, therefore, to compare with corporation tax in order to be able to establish what is the effect of corporation tax on the economy. The answer is quite simple. The effect of corporation tax on the economy is to reduce investment. We can then go to slide 24, which draws the obvious conclusion that if you can vary investment by changes in taxation, you can boost demand because more investment is higher demand, provided, of course, that the tax that you have to use in place of the tax you've reduced does not boost demand. But in fact, if you switch tax from investment to consumption, you do both. Reducing the tax on investment, and probably in most cases better still to subsidize it, boosts demand. If you put taxes on consumption, whatever means you choose, and you can be welfare neutral, doesn't have to hit any particular wealth sector of the economy more than others. You can put it by increasing taxes on income and taxes on consumption, even taxes on land will work. And what you will find is that A, the reduction of tax on investment boosts demand, and the increase of tax on consumption also reduces demand, also boosts demand because it lowers household savings. So tax policy is a very good weapon for boosting demand, and it is a weapon you need, as I will explain in chart 25, when the other two are not working. Chart 25, please. Sorry, slide 25, my beg your pardon. Confusing charts and slides. Can I see slide 25, please? Oh, thank you. Now, we can therefore use tax policy to achieve the balance and demand, which otherwise we would have to use either fiscal or monetary policy. And we don't want to use those in all circumstances. We don't want, for example, to raise debt to GDP ratios inexorably. And tax policy achieves a boost to demand without doing so. So we can use tax policy to do just what we need, which is to solve the structural ex-ante net savings problem, which has been the curse of the 21st century. A curse, by the way, which is Larry Summers refers to as I think it's structural stagnation, which I think is not as good a phrase as a ex-ante savings surplus, which is structural, because the conclusion that Summers tends to come to is you can't do anything about it. Whereas if you see it in terms of the balance of savings and investment, all you need to do is both boost investment, and you can do so by tax policy. If I can therefore move to chart 26, thanking all of you so far for giving me time to go through this quite long presentation. I hope not too long for you, and I hope it'll give you time to ask questions. The consensus model's assumptions are wrong, and its conclusion is wrong. One follows from the other. I think we must therefore discard it. We mustn't teach it in theory or use it as a guide to policy. And we can, to avoid the problems which it has itself created, which is the structural ex-ante saving surplus of the 21st century, we can solve that problem by introducing tax policy as a third policy instrument. And that will itself have a knock-on benefit, because we've also suffered not only from instability, but we've suffered from low growth. And as introducing tax policy will stimulate growth, we will, by its introduction, both enable us to have a stable economy, which we can't if we follow the consensus model's assumptions, and it will give us greater growth, which we badly need. So thank you everybody so far, and I'm very happy to answer any questions or to respond to any comments by the discussant or others. Thank you.
Thank you, David. This is Shahid. So thank you very much for a very enlightening lecture, and you explained a lot of the complications inherent in a functioning of an economy. So I'd like to go to the floor and see who has got their hands raised. James, would you like to go first?
Yes, I do. Can you hear me?
Yes, I can.
That's great. Thank you. Thanks very much, Mr. Smithers. What I'm actually worried about is if we do actually use tax policy and also decrease taxes actually on corporations and big businesses as well, and as you pointed out, they take the tax from the cash flow, would there be a temptation for those companies to put them back as dividends for the shareholders rather than reinvesting into their products and services?
Yes, James. In the book that I wrote previous to the economics of the stock market, I did write about the unfortunate impact of the bonus system on stimulating cash returns to buybacks, in particular, as preference to new investment. Now, I think it's possible to so design the cut in corporation tax that it is actually a subsidy on investment rather than a deduction in the headline rate. And this is what I would therefore strongly propose. If you introduce a subsidy, a cash credit, which already exists in the UK in a small extent and has existed in America since 1981 for intangibles. If you apply that to tangibles and you make sure that it's not a accelerated depreciation, but an actual tax credit, what you will then get is the actual inverse of what you get at the moment. Instead of earnings per share falling in the short run when investment takes place, earnings per share will rise. Now, earnings per share are the most fundamental element in which the bonus system is based. If you get earnings per share up, you will usually get a better bonus. So instead of finding, as we do at the moment, that we have a system whereby the bonus culture inhibits investment, we can move, if we use its basic follies and stupidities, if we use those to boost investment, we can do so by changing the way in which we tax corporations, not by changing the headline rate of corporation tax, but by introducing and increasing tax credits on tangible investment.
Right. Okay. Let's hope it does work that way. As you quite rightly pointed out, and others as well, it's the buyback system that has actually inflated share prices and what have you. So let's hope somebody takes heed of that. Thank you very much.
I share your hopes. Nothing that I can say would be a guarantee for the future. But I'm not unusual like that.
Yeah, thank you, James. We next go to Takashi.
I cannot. I'm trying to turn on my video, but I don't think that's working. Well, Andrew, it's always such a pleasure to see you. There we go. It's such a pleasure to see you live and in such good form. Thank you so much for your presentation. I had 2 questions. I read your book, The Economics of the Stock Market. It's very hard to disagree with because, as you've mentioned, you have been so robust in using testable hypotheses for everything. I was wondering, how do we go about changing consensus? Because, I perhaps the only way, given how academia seems to be so wedded to the current consensus that you just have to help a lot of people make money off your ideas, and it being how humans are. Perhaps if they see a lot of hedge funds and so forth making a lot of money off your ideas, perhaps this is how we get about to changing the academic consensus right now. Do you have any thoughts on how we go about it?
Well, it's a very important question, and all we can do is try. I'm trying here today, and with the great help of PIDE, for which I'm very grateful. I'm sure I'm relying on you, Takashi, to pass the word around as well as you can. I've been asked to give a Cambridge lecture called the Aaron Adam Lecture on the 26th of October, which will give me another opportunity. And I keep trying to spread the word. And that, I'm afraid, with your help, is all that we can do. Being, I hope, polite but firm when we point out the errors of people who disagree with us. Of course, being prepared to accept our own possible errors and to change if we find them. So far, the problem I faced in these discussions has not been that people point out to me and say, you're wrong. It is, unfortunately, that they don't terribly anxious to enter into debate. And I hope we can change that.
Well, I will try to make a lot of money, Andrew, and I will give you the credit for it. So let's see if that pans out. And I had just a small follow-up question. Over the years, I've really been fascinated by your analysis on the real returns on equity being so stable over time. And I was just trying to understand why do you think it works out like that? Is that something like, the invisible hand? What do you think are the mechanics by which we get this, being so stable over time? It's kind of almost, fantastic, but I just was wondering, what do you think is behind that?
I tried in the economics of the stock market to produce an explanation. And that explanation is based on the stability of risk preference or risk aversion in populations. Now, the risk aversion of individuals differs, but the risk aversion of a population probably remains stable. And it is populations through which we inherit these types. And I quote in the book the Nobel Prize winner, Peter Medawar, who points out that you can use, therefore, populations for stability. You don't have to, and nonetheless, of course, a given population can become itself more optimistic or pessimistic. But over time, a stable population will produce a stable amount of risk aversion, and a stable amount of risk aversion will, I think, quite naturally produce a stable return on equity. What is more, of course, after a while, if you have that, it gets hardwired in. So when you get other changes taking place, the changes that they cause, they tend to give the change on the competing assets, such as long bonds. So long bond yields can change a bit, and they're not, as we know, related to the returns on equity. But you can have some swings in such things as the extent to which pensions are being funded by defined benefits or defined contributions, which make quite a difference, as we can see in the collapse of the relative poor performance of the UK market over the last 20 years. These can have big impacts over the short term, but they don't necessarily cause a change in the mean reversion stationarity of the equity return.
Andrew, thank you so much.
Thank you, Takashi. And when you do make that money, do share it with Andrew and with us too. That's very generous of you.
Yes.
Thank you.
Right, thank you very much. Let me see if I can unmute the video too. No worries.
Martin, can you speak up, please?
Oh, yes, is that better?
Thank you.
Lovely, thank you. Well, I think I'd like to say I've been very impressed by your work, Andrew. As soon as I came across it, it made sort of common sense to me when I got a copy of the stock market, the revaluing stock, Wall Street Revalued, and then I went back and bought the earlier book and I bought all your books since then. To me, your thesis does make a pretty good intuitive sense. I agree the bonus culture is clearly a huge problem. I don't know whether anyone here knew the late Peter Montagnon. I do hope so. But he was extremely clear that executive pay should not be dilutive of shareholders. In other words, the shareholder wealth shouldn't be given away. His idea was to encourage or require senior managers to buy existing shares in the market and hold them for long periods. That means they will be less fussed about what happens to the stock price in the short term. We've also got a horrible problem whereby fund managers are judged on short-term performance. And we all know how non-meaningful really is many fund managers' long-term performance. Not many perform over the long term very well. So the whole world is focused on the short term. And the media seems to work that way. Human nature seems to work that way. And so long as we think about what we quote make in the stock market as being what happened to the price, as opposed to what do I own that's been earned for me, I think we've got a problem. I think your analysis is totally right, and the whole approach to remunerating leaders needs to change. but it would be lovely to hear of any straws in the wind where people are thinking that way. That was my thought.
Well, thank you, Martin. As I agree with your analysis and complaints, but as I point out, we can use this, frankly, folly to boost the economy by introducing subsidies on investment, which actually tend to push up rather than push down bonuses. So, although I would rather see an absence of the bonus culture, I'm in favor of using it if it exists in order to improve our performance.
In the end, Andrew, thank you very much for your time. We really appreciate you taking out time to speak to us on an important issue. PIDE, as Dr. Nadeem said at the very start, we invite varied point of views and on lectures on all the stuff that matters to economics. And this one was no different, a very enlightening one. Thank you very much for sharing your knowledge and your thoughts with us. We'll definitely in the future be inviting you again to speak on similar issues. We again thank you. Please do accept our thanks.
Well, thank you very much. And I've been, as I say, a privilege to talk to the Institute, and I greatly appreciate the opportunity you've given me. And if I can add just one thing, if any of you are listening wish to ask a question, I do pride myself on being a good answer of our emails. And I'm sure, Shahid, you will make sure that everybody who's here has a copy of my email, and if therefore they wish to ask questions, they will do so. And with that note, thank you very much for your attention. I'm flattered by it, and thank you very much. And thank you, Vice Chancellor, for organizing it and for your kind introduction, and for Professor Zulfikar for organizing it all, and Shahid for running it. Thank you very much.
Thank you, Andrew. And definitely we'll be sharing your email with everyone, whoever has a question to ask from you. And that's very kind of you, very generous of you to share your knowledge. So it again goes to the proof that what Milton Friedman said about there is no such thing as free lunch, but I guess you are offering one, and he used to offer a lot of advice without any price. So that I guess is free lunch. Thank you so much again for being with us, and we'll share your email with everyone. Take care. Gentlemen, that's it for this webinar. We hope to see you again in the next one. Thank you.
Thank you very much.